We invite you on a journey through the history of financial markets. From ancient bartering to modern high-tech platforms and cryptocurrencies, this is a fascinating story of the highs, lows, ideas, and mistakes that have shaped our world today. In this video, we look at the key moments in the evolution of financial markets and find out why knowing the past is important and how it helps us navigate the present and predict the future. The history of the development of financial markets goes back long before the appearance of the common forms of money, stocks, and bonds. In ancient times, people exchanged goods without using money, resorting to the practice of barter. Over time, it became necessary to create a universal unit of measurement for the value of goods, which led to the appearance of the first money. One of the earliest examples of money was the cowrie shell used in China and Africa. They were easy to carry and store, and because they were so rare, they were very valuable. Later, metal coins were minted, such as silver shekels in Mesopotamia and gold staters in Lydia. Coins became a convenient medium of exchange because their value was guaranteed by the state, which greatly facilitated trade. During the Middle Ages, trade continued to develop, along with the need to store and move large amounts of money. This led to the development of banks. One of the first famous banks was established in Venice in the 12th century. Bankers provided services for the storage of valuables, the granting of loans, and international payments. Usury, the practice of making interest-bearing loans, became an important part of the financial system of the time. Despite the church's condemnation of the practice, it remained popular among merchants and the aristocracy. One of the most important innovations of the Middle Ages was the promissory note, a document confirming an obligation to pay a certain amount of money in the future. Promissory notes allowed merchants and traders to conduct transactions over long distances without having to transport large amounts of cash. It was also during this period that the first forms of insurance appeared. For example, Genoese merchants contracted to insure their ships and cargoes against possible loss at sea. The 17th to 18th centuries were characterized by the rapid development of trade and industry. During this period, the first stock exchanges appeared. The Amsterdam Stock Exchange, founded in 1602, is one of the oldest stock exchanges in the world and played a key role in the development of the modern securities trading system. This exchange was created to serve the needs of the Dutch East India Company, VOC, which was the first major international corporation to issue shares to raise capital from the general public. The VOC shares became the world's first freely traded securities, laying the foundation for the development of the modern stock market. Trading on the Amsterdam Stock Exchange was characterized by a high degree of organization and formalization. For the first time, strict rules and procedures were introduced to ensure transparency and security of transactions. These included fixed trading hours, registration of bidders, and the creation of specialized brokers to act as intermediaries between buyers and sellers of securities. The Amsterdam Stock Exchange became the birthplace of the first financial instruments, such as futures and options, which were used to hedge risks and speculation. Stock exchanges became centers of economic activity, attracting investors from around the world. Stocks gave people a way to invest their savings in promising companies and profit from their success. Stock trading allowed companies to raise significant capital to expand their businesses. Investors could buy shares and expect to receive dividends and increase the value of their investment as the company grew. Bonds, on the other hand, were debt obligations of governments or private companies. Bond buyers received a fixed income and could sell the bond on the secondary market if they needed cash before maturity. The 20th century began with global upheaval. The Great Depression of 1929 led to a massive market crash and the bankruptcy of many banks. Millions of people lost their jobs, banks closed, and confidence in the financial markets plummeted. This crisis forced governments to rethink their approaches to regulating the economy. New institutions were created, such as the Federal Reserve System in the United States, to control the money supply and prevent similar disasters in the future. Central banks became key players on the global stage. They control the issue of money, set interest rates, and regulate the activities of commercial banks. The main task of central banks is to maintain the stability of the national currency and prevent inflation. Economic regulation included the creation of laws and standards to protect the rights of investors and consumers. For example, the United States passed the Securities Act of 1933, which requires issuers of stock to provide complete and reliable information about their business. Globalization and digitization have made financial markets international and accessible to a wide range of users. Electronic trading platforms such as NASDAQ and NYSE allow for real-time transactions, and the internet has made access to financial instruments almost ubiquitous. However, globalization has brought with it not only positive aspects, but also serious problems. The financial crisis of 2008 demonstrated the extent to which financial markets are influenced by external factors, such as excessive credit expansion and speculation in real estate markets. The 2008 crisis was one of the greatest financial disasters of our time. Its roots go back to the beginning of the 21st century, when the U.S. mortgage market began to experience significant difficulties. Excessive credit expansion, low interest rates, and lax regulation created the conditions for a massive proliferation of subprime mortgages. These loans were made to borrowers with poor credit histories, increasing the risk of default. When housing prices began to fall, many borrowers found themselves unable to meet their mortgage obligations. This led to massive defaults and a sharp deterioration in the condition of banks and other financial institutions that held large amounts of toxic mortgage-related assets on their balance sheets. The fall of Lehman Brothers, one of the world's largest investment banks, became a symbol of the crisis. After its bankruptcy, confidence in the financial markets was severely undermined, and the chain reaction that followed led to a global recession. Governments and central banks in various countries were forced to take emergency measures to stabilize the situation, including quantitative easing programs, lower interest rates, and support for key sectors of the economy. Modern exchanges play a key role in the functioning of global financial markets. They provide a platform for trading various financial instruments such as stocks, bonds, derivatives, and other assets. Modern exchanges are characterized by a high degree of automation and the use of advanced information technologies. NASDAQ and NYSE are among the largest and most influential exchanges in the world. NASDAQ specializes in trading shares of high-tech companies and is a pioneer in electronic trading systems. The NYSE, on the other hand, has a more traditional structure and is known for its open auctions. These exchanges offer investors a wide range of trading and investment opportunities. Electronic platforms allow transactions to be completed in real time, making the trading process faster and more efficient. In addition, modern exchanges are actively working to improve the transparency and security of trading operations using the latest technologies, such as blockchain. Cryptocurrencies and blockchain technologies are one of the most revolutionary and discussed topics in the modern financial world. Bitcoin, created by Satoshi Nakamoto in 2009, was the first successful implementation of a decentralized digital currency. The blockchain underlying Bitcoin is a distributed ledger of transactions that ensures transparency, security, and immutability of records. The main characteristics of the blockchain include decentralization, the absence of a single control center, and a high degree of protection against manipulation. These characteristics make blockchain attractive not only for cryptocurrencies, but also for other areas such as logistics, healthcare, and government services. Since the advent of Bitcoin, many other cryptocurrencies and blockchain-based projects have emerged. Some of them focus on increasing the anonymity of transactions, while others try to improve the scalability and speed of transaction processing. However, cryptocurrencies remain extremely volatile and subject to significant price fluctuations, creating both opportunities and risks for investors. The future of finance is full of opportunities and challenges. New technologies, such as artificial intelligence and machine learning, are being actively introduced into the management of investments and financial instruments. Robo-advisors are helping retail investors make decisions based on big data analytics, and blockchain continues to evolve, creating new opportunities for its integration into the economy. Despite the potential difficulties associated with the introduction of innovative technologies, the financial system remains flexible and adaptable to change. Financial risk management and the introduction of modern control methods will help stabilize the economy and ensure long-term prosperity. We have reviewed the 1,000-year history of financial markets. We have seen simple exchanges evolve into complex financial instruments, as usury and promissory notes gave way to stocks and bonds, and then to cryptocurrencies. Financial markets continue to evolve, adapting to new technologies and global changes. Remember that success in finance depends not only on luck, but also on knowledge, experience, and the ability to assess the situation correctly. Continue to learn and explore new opportunities. Thank you for your attention, and see you soon in the world of finance.